Hello, my fellow Canadian investors. I am Justin from Tater, and in this video, we are going to compare the standard portfolios from CI Direct to those offered from RBC. To begin, we will look at CI Direct's safety portfolio and the RBC equivalent, the very conservative portfolio. Looking at the two side by side, you can see very similar allocations to equities and fixed income. The MER considerably lower for the RBC portfolio. However, the CI Direct portfolio has a respectable MER as well at 0.17%. Diving into the specific ETFs in each portfolio, you can see that both have XBB, which is a Canadian aggregate bond index ETF, primarily consisting of government bonds with a small amount of high quality or otherwise called investment grade corporate bonds. That is the only common ETF between both portfolios. However, each have very similar structures and some very similar ETFs that attempt to do the same thing. So, keeping with fixed income, both portfolios have a global aggregate bond ETF, providing exposure to the bond market outside of Canada. And it is important to note that both of these ETFs are currency hedged back to the Canadian dollar. And generally speaking, hedging to the Canadian dollar is what you would want to do in this situation because the fixed income or bond portion of your portfolio is supposed to be reliable and stable. So you certainly don't want to increase the potential volatility of this portion of your portfolio by having exposure to foreign currencies. On to a few differences in the portfolio. The CI Direct safety portfolio has CSAV, which is CI Direct's high interest savings ETF. So this is the equivalent of a high interest savings account, but just in the form of an ETF. And in fact, these ETFs typically provide a significantly higher interest rate than traditional savings accounts, primarily because institutions like CI Direct can go to the big banks and negotiate a higher interest rate just because they have much larger pools of money than your average investor. Instead of a high-interest savings ETF, the RBC portfolio offers XSB, which is a short-term bond ETF. In terms of fixed income investments, the only other difference between the two portfolios is that CI Direct offers ZJK, which is a high-yield or junk bond ETF, which are known for offering higher returns with greater risk. On to the equity ETFs. The CI Direct portfolio has 7% in Canadian equities versus 10% in the RBC very conservative portfolio. U.S. equities come in at 6.5% in the CI Direct portfolio compared to 5% in the RBC portfolio, 5.5% international equities in the CI Direct versus 5% in the RBC portfolio. All of these equity ETFs are traditional index funds which seek to track a broad-based index consisting of equities, otherwise known as stocks. And these indexes are cap-weighted, which means each stock in the index is weighted relative to its total market capitalization. So companies with a larger market cap have a more sizable percentage of the portfolio. So they are pretty similar portfolios overall, with a few relatively minor differences. Let's now hop back over to our Tater Portfolio Manager, and we will click on the CI Direct Safety and RBC Very Conservative portfolios, the boxes beside the names of each portfolio, of course, so that we essentially close them out and they disappear along the menu bar. And let's now open up the CI Direct Conservative and RBC Conservative portfolios. We are going to see many of the same ETFs that we saw in the previous portfolio. The only additional ETF that CI Direct has added is the Emerging Markets Equity ETF, CIEM. This one is actually actively managed, hence the high fee, the much higher than average 1.12% MER. So it's actively managed, which means CI Direct appoints a portfolio advisor who looks for specific emerging market funds or equities or stocks that serve customers in emerging markets. So much different than XEC, the RBC Emerging Markets ETF that you will see introduced in the balanced portfolio. Owning that one means that you own over 1,500 stocks from emerging markets, and the intent is to replicate one of the emerging market indexes, whereas the objective of the CI Direct ETF is to beat or get a higher return than the entire emerging market. So pretty significant differences between the two ETFs. The RBC fund is more like a traditional index fund, whereas the CI Direct ETF is more like a higher fee, actively managed mutual fund. Okay, so let's hop back over and look at the portfolio breakdowns once again. Compared to its safety counterpart, CI Direct's conservative portfolio overall MER has gone up 2 basis points, or 0.02%, up to 0.19%. Overall, we've got 37% equities compared to 63% fixed income versus the RBC conservative portfolio. Similar proportions of each, in this case a little bit less, 35% equities. All of the same ETFs are found in the conservative portfolio versus the RBC very conservative portfolio, just of course a larger allocation towards equities. And the MER has gone up slightly, now at 0.12%. Looking at the RBC balanced portfolio, we see all of the same ETFs that RBC has in their more conservative portfolios, except they have gotten rid of XSB, the short-term bond ETF. The only two fixed income ETFs still in the portfolio are XBB and XGGB. In addition to the balanced portfolio that we didn't see in either of the RBC conservative portfolios is the aforementioned XEC, their emerging market equity ETF. The MER has risen 1 basis point again, up to 0.13%. And otherwise, there are no other changes to the portfolio, except, of course, a larger allocation towards equities. Hopping over to the CI Direct portfolio, very similar to its RBC counterpart in terms of the mix of equities and fixed income. Changes to this portfolio versus CI Direct's conservative portfolio, obviously a larger allocation towards equities. They have ditched CSAV, the high interest savings ETF, in favor of a short-term bond ETF, which has ticker symbol FSB. You will note the word enhanced in the security name. This ETF is not a traditional bond index ETF. It doesn't track an index. Rather, it tries to beat the other short-term bond indexes. So the trade-off would be a higher MER and slightly higher risk. This ETF invests in Canadian and US bonds, mostly government bonds, but also some corporate. And not all of those corporate bonds are investment grade, i.e. low risk. Some of them have greater risk and offer a higher yield, and these bonds are called either high yield or junk bonds. About a third of the ETF, it invests in cash or cash equivalents, which would be savings accounts and very short-term bonds. One last note on the balanced portfolio is that the MER has gone up once again to 0.23%, where it will remain for CI Direct's growth and aggressive portfolios. Hopping over to the CI Direct growth portfolio, all of the same ETFs as the balanced portfolio, just with, of course, a higher allocation, higher weighting towards equities. Over to the RBC growth portfolio, very similar weighting towards equities. All of the same ETFs as the RBC balanced portfolio. And the overall MER has held steady at 0.13%, where it will remain, as we can see in the RBC aggressive growth portfolio. And some other notes for this one. All of the fixed income is gone except for the 2% in cash. The remaining ETFs are all equities. So this is a very aggressive portfolio. And this is where the two institutions differ a little bit. CI Direct's portfolio, as you can see, 80% equities compared to the 98% in the RBC portfolio. In terms of the ETFs in CI Direct's aggressive growth portfolio, you have all of the same as the growth portfolio, except they have gotten rid of the junk bond ETF, ZJK. This concludes our comparison between the CI Direct and RBC standard portfolio offerings. We hope you found this video helpful and informative. Please like and subscribe, and check out mytater.ca, where you can duplicate just about any Robo-Advisor portfolio out there and cut out all of the fees that would otherwise be paid to the banks and brokerages. And those fees can be 0.5% or more and take a huge chunk out of your investment portfolio. We are talking like 6 or even 7 figures over the long term. So check it out. We will see you next time.